The ES failed to break out of a previous high, so it dipped into a previous high. First, the S&P 500 did it, dipped into a previous high, and then closed below that previous high. That was the first day that you could perceive the failed breakout at highs. And then yesterday we had another dip into highs that closed below the previous high. That is also a perceived failed breakout. Then we had our extension long levels break. And so all of a sudden here, the signs of a turning point, you have a VIX long developing. You have the indices shorts. Bank is inside of a weakness event. And then there's little dollar strength trades. And we had 4 unfilled gaps that were below us. We've filled 3 of them. So we came out of our highs out of the 20 handle this morning. The 20 handle had a 69% probability of leading us to the gap fill. We filled the half, we filled the full, and then the markets broke down, and we have a little double top here inside of a double top. Now, what we're going to explore here inside of our leading indicators is what setups would suggest the continuation of that weakness event. And when we're looking at the dollar, I'm zoomed out here to the monthly charts. And it's important to look at this large of a time frame because we're going straight down inside of an extension short. Now, currently, the dollar correlations that we have right now are negative for the currencies and gold, silver, and crude oil. There's a bit of a neutral correlation here with the indices on the 30-day period, but it is turning slightly negative over the 15-day. Why that is important is because if this dollar weakness trade continues, we would expect that there would be tailwinds behind the currencies, gold, silver, and crude oil. The currencies, the euro, pound, Aussie dollar, gold, silver, crude oil. Those are the negative correlations. Now there's a neutral correlation inside of the indices, meaning that there's no effect. Where is the dollar getting in the way of those negative correlations continuing to create new highs? And DXY has the extension short and a bearish below line in the sand here with the 97,217, but we keep running into this little dollar strength trade that we haven't yet broken. And that dotted line that you see is also the previous low, that old support. Dipping into it could act as a level that could lead us through the extensions. So we're watching that very, very closely here. And what happens if that negative correlation does start to come out inside of our indices? Well, this is where that little pullback is where the dollar strength in the intraday time frame comes from and creates a headwind for negative correlations that are starting to come out on that chart. What about the bank chart? Now, bank has weakened all day. It's just sitting at lows of the week. We don't necessarily have a resistance level, right? We haven't run into resistance. Bank isn't technical. Like it's just an index. It's not like other markets that are, are actually traded. But bank so far has not ripped through highs and not shown us any real strength that would give the indices a tailwind, at least in the intraday timeframes. And then there's the VIX. Now, the VIX defended. We call this the VIX explosion setup. And it is when the old contract lows to the new contract highs makes a pullback. Now, yesterday, this stream continues at emoneyaddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.